Wall Street is celebrating a pause, but they are completely blinded to the trap that's just been set. On June 17th, the Federal Reserve voted unanimously to keep interest rates steady at 3.5 to 3.75%. On the surface, the markets breathed a sigh of relief. The S&P 500 is hovering near record highs. But behind closed doors, something shifted that hasn't happened in years. The dot plot. The secret map of where federal officials actually think rates are going. Just completely flipped. Welcome back to American Trade. If you think the inflation fight is over and rate cuts are coming to save your portfolio, I have some bad news. We are staring down a hawkish pivot under new Fed Chair Kevin Warsh, a fracturing global supply chain, and a word economists are terrified to say out loud, stagflation. Let's look at the data. Let's look at the actual numbers from the meeting. Yes, the vote had hold was 12-0, but when you look at the 80 participants who submitted projections, 9 of them now see interest rates ending 2026 higher than they are right now. The median expectation shot up from 3.4 back in March to 3.8 today. The Fed didn't just pause, they took away the easing basis. The language about potential rate cuts is gone. Why? Because the economy is trapped between two massive fires. On one hand, domestic consumer spending is finally showing fatigue. Real disposable income is down and retail sales are sluggish. On the other hand, a low-fire job market is keeping unemployment stable, but inflation is refusing to drop to the 2% goal. Half of the Fed committee is already preparing to hike rates again before the end of the year. The Fed pivot isn't just delayed, it's dead. But the Fed doesn't operate in a vacuum. The real driver of this sticky inflation isn't just domestic, it's geopolitical. The ongoing conflicts in the Middle East have moved past localized skirmishes. They are now a full-blown macro crisis. Crude oil prices and commodity risk premiums have surged, throwing a massive wrench into global trade. For countries heavily reliant on energy imports like Europe and parts of Asia, this is a crisis of both prices and supply volume. And while the U.S. produces a lot of its own energy, we aren't immune. Higher gasoline prices act as a direct tax on the American consumer. When gas goes up, discretionary spending goes down. At the same time, ongoing trade frictions and threats of fresh 10% tariffs on international trade partners are driving up the baseline cost of imported goods. This supply-side inflation. The Fed cannot fix a broken shipping lane or an oil embargo by raising interest rates, but they will raise rates anyway to stop the bleeding. So why are equity markets still pushing higher? Because investors are suffering from a dangerous delusion. Right now, the stock market, driven largely by AI infrastructure, semiconductor reshoring, and mega cap tech, is betting that corporations can simply absorb the higher capital costs. They're assuming that the inflationary impulses from the Middle East will just fade away. But history tells us a different story. When you have slowing growth mixed with rising supply-side inflation, you get stagflation. And it's the ultimate nightmare for an investor because the traditional 60-40 portfolio breakdown doesn't work. Both stocks and bonds get crushed simultaneously. As players in American trade, you cannot afford to invest based on wishful thinking. Liquidity is tightening. Rating agencies are already questioning the sustainability of U.S. sovereign debt as interest costs balloon. The smart money is rotating out of hyper-expensive discretionary sectors and moving into hard assets, defense, and high free cash flow companies that can survive a higher for longer interest rate environment. The economic landscape has shifted. If you want to keep your wealth intact, you need to stay ahead of the macro data. Hit the subscribe button and turn on notifications and drop a comment below. Do you think the Fed will actually dare to raise rates against this year? Thanks for watching American Trade. See you on the next block.